Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am the CEO of Sound Financial Group, as Corey often reminds me that I'm no longer president because he is with and joined by Corey Shepard, a man who does often wear a blue shirt, but whose attitude is never blue. Always
Paul,
here.
I just wonder, is it you? Are you like, drifting off to sleep? I picture you drifting off to sleep every night, thinking of the things you can say for the intro, and it makes me feel good. It makes it like, oh, he's thinking of me like every single nugget. Aw.
That's I would love that to be the case. Although I usually think of it while I'm saying, "Welcome to Your Business, Your Wealth."
I know,
and that's the reason why that intro is not always high quality. So we just gave people a little look behind the curtain. It's because I am making it up as I go. Speaking of making it up as I go, we are digging into the things that you get exposed to every single week. In our audience, you get a chance to read the news, and you might be reading the news for other purposes, but there's always these headlines and articles that come up. And kind of rather than us going down the path and always kind of teaching something that's maybe not in the headlines or not in the news, like teaching on the things that you're going to bump into anyway, giving you a better chance to absorb that information differently and make different decisions with your money. So we got 3 great articles for you today.
Really great.
Yeah, we got one on this kid who was a first-time trader on Robinhood who managed to get themselves a huge 6-figure tax bill on how much profit, Corey?
45,000.
Yeah, so that's going to be a fun one for us to talk about. We also have an article on how these Wall Street firms are hiring tons of new people and whether or not that's a good thing for the consumer because of what's happened in past market highs when large financial institutions go on hiring sprees. Mm-hmm. And then last but not least is us covering Suze Orman's best financial advice as made up by, interpreted by some journalist somewhere whose name we will talk about, but we don't need to get to that yet. As we get into this, we are going into the fourth quarter, right? We've just finished a heck of a year for many of us, a heck of a last 2 years, or as I like to say, the toughest part, Corey, about 2 weeks to stop the spread is just the first 18 months. After that, it gets pretty easy. So we should be rounding a corner here to be able to have life maybe get a little more settled down and less of what the last 18 months have been.
Right.
But to not forget that there are some tax changes coming up. There are new tax proposals coming up that'll probably be on next week's show. So what I want all of you to be thinking about is what are the things that you need to do this year to set yourself up well tax-wise? And more importantly, what either habits or practices or costs that you need to change in your lifestyle to set yourselves up for 2022, because that prep work starts now. It doesn't start just the January of next year. This is the time that you're probably starting to get from your companies, or if you're a business owner, you're starting to have your team think about their plans for 2022. But it also makes sense for you and your spouse to sit down and talk about your plans for 2022 and how you're going to further your financial aims. So, Corey, if you're good, I'm going to go to you first on this Robinhood article.
Sure. And yes, this is 2 weeks in a row that we're talking about Robinhood, but this article's a little bit different because it's not really talking about the company per se. The headline happens to be Robinhood, but someone could do this to themselves on lots of different platforms. It just happens to be that Robinhood makes it so friction free to do some of this trading that it's maybe a lot easier, a little oil on that slide to slide you down that slope. So here is the important thing to understand, this concept of a wash sale. So folks are on Robinhood or all kinds of different trading platforms, buying and selling stocks in rapid fashion, holding for short amounts of time, turning them over, and then coming back to them sometimes. And so the IRS in particular has known that this is an issue for a really long time. And they just say, well, hey, if you're buying this security and selling it right now, if you bought or sold it 30 days earlier or later, then we're just going to kind of all count it as one. It flows one into the other. You can't, it washes together. That's why it's called a wash sale.
Meaning, and said differently, what people will do is they'll sell a stock that say lost $1,000. And the idea is I could book that as a loss against other gains. But to Corey's point, if you do that in less than 30 days, they cancel out your ability to produce that write-off against the gains you would have had.
So the example in the article is you buy 100 shares at $10 a share, you sell them at $7 a share, which means you have a loss of $3 per share, $300. But then the very next week, you purchase them again at $6. Well, that wipes out your loss. You don't get to keep that loss just because you had sold it before, because you didn't wait long enough. So that means that you actually have a bigger gain to pay taxes on, but you don't always have the money. And that's what happened to this person. Now, it could be a 21-year-old that's an unidentified retail trader. So they could be a 21-year-old buying their first stocks. They did put 30 grand into the account. So that's either like a lot of bar mitzvah money, or they're maybe a little bit older and put some money together over time. But here's the other trick. Robinhood gave them 90,000 on margin, meaning he only put 30 in, but he was able to trade with 90 because Robinhood will lend you a little bit of their money to go do some trading. Now, again, if you didn't listen to our show last week, go back and listen to how Robinhood makes money, which is not on us making money, but on us trying to make money, which is a very different thing. And that's why they're very eager to give us more room to move, because the more we trade, the more that they make.
Well, and that's, speaking of the amount of trading, I'm just highlighting this for our audience, is that he traded so much. It was $45 million of total volume of trades.
So think about that. 40. What is that? 45 million divided by 90,000. That's turning over his portfolio 500 times in the course of that year.
Which is like, if they're doing 10 to 50 trades a day, that might just be 100 days. But 100 days of trading that much is, I would think, dang near a full-time job, or should be if you're researching all those trades properly.
Mm-hmm. So his total profit was $45,000 at the end of the day. That's like actual more cash that he had in his account than when he started. But because of this rapid trading and the wash sale rule, he had actually generated $1.4 million in capital gains tax. Now, if you're holding a stock for less than a year, that's all taxed as ordinary income. So whatever other money he made, that $1.4 million went right on top, ratcheting him up the tax brackets, and that's why his potential tax bill was around $800,000, because he got himself into the top marginal income tax bracket with phantom money.
Well, and if we think about it, Corey, just kind of coming away from our screen share for a moment, this might be a super successful trader, meaning like they really had somewhere in their trades 1.4 million of profits, but when it comes time to close out the year and actually have to pay the taxes, if they recognize those gains, then reinvested, having to take the gains that they already sold, but now the value of those stocks is down when it comes time to pay the IRS, you literally can have a tax bill and not have the asset to pay the tax bill.
It's wild.
And it is what it comes down to, that we talk with our clients a lot about, and we talk on the show a lot about, is that it's important that you increase your human capital in any endeavor you're trying to produce an outsized return. And in this case, this person spent all their time just focusing on which stock they thought was going to move a certain direction, and not enough time in understanding the basic tax consequences of those decisions. So as always, when you're going into a new space and you think you're going to produce high returns, whether that's real estate, stock trading, crypto, you want to make sure that you can identify where your human capital is actually producing some value in the marketplace that would have you rewarded the way you're being rewarded. Because without that, you can end up in a situation like this, where there's an unknown circumstance you didn't know how to plan for. And not that the information wasn't available, but you hadn't synthesized it in your life in a way that actually helped you benefit from those higher returns. Mm-hmm. So
one other really quick thing on this article, if you notice towards the end, they reference this financial advisor, Brian Ruck, and then per Forbes. So there's this really hard to see link. Mm-hmm. When you click it, it takes you to the Forbes article that was the source for this article on the hustle. And so think about this. If someone else had referenced this article as a quote to talk about it, you'd have 3 different sources, but that's really one source. Now it's Forbes, and I looked through it, and it says all the same things, and we know that the wash sale is real. We can verify that. But if this was some other topic, you could really easily get into a situation where one bad source created 3 different references, and you thought it was real, but it really had no grounding in reality. So that's always something to watch out for with these linking articles and articles referencing each other.
Yes, great point. I think in journalism, they call it Geocitis, where one person writes an article, then it gets referenced, maybe even on Wikipedia. And yet it was all based on an initial set of data that didn't even back up the original headline of the first story.
Right.
And so, so to your point, it's like when we're reading these things, you don't want to read financial articles as an uncritical reader. You want to read them. You want to say, where does it apply to me? But then be critical enough to know, where does the data come from? Speaking of which, let's talk about the data of Wall Street and what kinds of things they're doing in this marketplace. Now, I got to get ads closed out of the way, etc. But this is Fidelity's history of adding lots of staff just as the market is peaking is the subtitle. The main title is Fidelity Hiring Spree is a Cautionary Signal. So I've got that up on the screen now, Corey. When you read this, what's the first thing that popped in your head?
So it was actually an old book called Where the Customer's Yachts. And it was written about Wall Street. And it was the author basically observed that in New York, floating in the harbor is all the yachts of all the traders, but where are the customers' yachts and who's really making money? And so, Wall Street does a good job of always making money as it's riding the ups and downs of the market. So just one of the things that I thought in my head was, okay, there are 9,000 new hires, get a lot of new assets really quick. Even if the market's going to tank soon, they don't care because all that money came in, and yes, it'll drop in value, but they can fire whatever more than the drop in revenue to still come out ahead for the next year, even if we're in the middle of a market recession. And
that for our audience who's listening, I want you to know what Corey's talking about is that hit him his first blush based upon that book he'd read in the past, Where the Customer's Yachts. First sentence is, when I heard the news that Fidelity Investments plans to make 9,000 new hires, mostly in client-facing and technology-related positions, I immediately thought of the old adage that Wall Street hires on the highs and fires on the lows. Because they attract all those new customers and all the new revenue, but they can, for lack of a better way of saying it, hit delete on the overhead associated with that.
And while the market balances would have dropped, it doesn't, firing all those people that helped get the money in doesn't push all that money back out.
Right.
So they can manage that really well. for themselves.
Well, and we've seen this in other places. You see it. In fact, one old adage I remember learning, this is when the real estate market was really booming. And at that time in 2005, 2006, I still lived in Las Vegas. And I was just remember eating at an Outback Steakhouse. And somebody there was
Bloomin' Onion. Did you get the Bloomin' Onion?
Oh, back then I was eating bloomin' onions like they were Tic Tacs. And the waiter or waitress, I don't remember which, young person came up and we're talking. They're like, yeah, and I'm also going into real estate. And I, got a couple listings, all that. And there was somebody I was eating dinner with who then, as they walked away, said, what's funny about these booms that happen? The average income of the professionals in the field actually drops. I was like, how could that be? Every real estate agent I know is crushing it. Every mortgage person I know is crushing it. He goes, that's true. But so many new people come into that marketplace and they can drive the average income down. Now, what maybe is good in the long run for the financial sector is if you recruit a bunch of people, some of them will be absolute gems that maybe you wouldn't have recruited otherwise. And in theory, when you clean house and the market goes down, you end up putting yourself in a position to keep the top graded folks. But the problem is if you're a customer and what these companies are doing is hiring based upon all the new influx, all that, like what happens to the service side of these institutions that are customer direct? Like Corey, you and I get a fair amount of experience of what it's like running interference with all the difficulties that financial institutions, not on purpose, but unintentionally cause for their customers. And we kind of stand between that for our customers. Mm-hmm. But we've seen customers have to deal directly with some of these financial institutions when things don't go to plan. And it's a heck of a mess. And I can't imagine it would only be worse if when whatever happens, maybe it's growth stocks go through the mean reversion that we've been waiting for, or crypto has some kind of major problem and really hurts the revenues of these companies. What does the customer service look like? We all got a small taste of it during COVID when you'd call a customer service department that used to have an 800 number. They said, due to COVID-19, please send an email here and we'll try to get back to you within 5 days. Well, when it's your money, that may not be, a tolerable outcome. Yeah. So it's the question that they ask in here is like, is this new level of trading activity going to stick? And odds are probably not. We've been in a market that's been very favorable for individual traders trying to make money in the market because it's been volatile and generally volatile to the upside. Reminds me a lot of the late 90s where I was early in the business, joined in 1998, and one of the first things I got exposed to are people like dentists leaving their practices that they had worked in for 15 years to day trade. And about 3 years later, many of them were back working for another dentist because they had already sold their practice, invested that money into their trading strategy, and it didn't work out. And as always, speculation does work out for some. So some of these people could make a ton of money doing this trading, but this speaks to something you said earlier before we get off this article, Corey, is that one of the things that they mention is from a competitive standpoint, Fidelity may lack the cool factor and gamification that Robinhood Markets provides, but it's still doing a decent job of convincing younger investors to open accounts. Again, their aim isn't disciplined investment strategies from their customers. It's to open accounts, make deposits, start trading. That's what they're after. But what I love about...
I would give Fidelity... Like if I'm Fidelity probably has more of a focus on a long-term accumulation versus the gamification that Robinhood has.
But think about that. That's what I wanted to point to is that it's almost like they said the quiet part out loud that financial journalists aren't supposed to talk about, which is like literally the reason, like they're trying to say it in a way that sort of edifies Robinhood. Like, look what a great job they've done, is they are gamifying us being in activities that produces yachts for the owners of the financial institutions and their top executives, but not activities that produce yachts for their customers.
Right.
So, any case, so the curious thing about it is that these companies are beginning to hire. They're trying to ramp up because they want to take the most advantage they can of all this new retail level customer spending, which makes sense because if you look at what the market's done the last 18 months, it's been on fire since the lows of COVID. And if you've been investing since March of last year and you've lost money, that would be a really good reason to be able to go out and hire an advisor. But it could also be a really good reason if you've made a ton of money. It may be a very good reason to go engage an advisor to have them look at what kind of disciplined strategy will keep those gains on your balance sheet for the long run. So now, my favorite multifaceted article of the day, because we get to talk about the financial journalist, financial journalism, and one of the biggest, I don't know, we could say personal finance figureheads or one of the biggest financial entertainers out there. And that is Suze Orman. Now, this is an article that is from The Ascent, which is a Motley Fool property. And what they've done is written an article called Suze Orman's 5 Best Pieces of Financial Advice. Now, we're going to get into why that may or may not be accurate, but let's talk about Suze Orman for a moment. Suze Orman's job is not to be a financial advisor. By the way, neither is Dave Ramsey, any of those. Their job is to be a financial entertainer. Now, how do we distinguish that? One of the easiest ways to think about a financial advisor versus an entertainer would be if you got bad advice from them. And let's say you took them to court. So, Corey, I'll ask you, since I can't just ask our audience.
Yeah, let's do it.
Okay, so I get a bad piece of advice from Suze on a radio show. And it doesn't work out for me. It costs me tens of thousands of dollars. And I take her to court. And I say to the judge, Suze gave me this advice. I was on the phone with her. I didn't just take it off the radio show. I actually called in. She said I should do this. What does the judge say?
Well, the judge might ask, did you have any kind of contract with Suze? Was there any agreement that you formed?
No, I've been listening to years. Just been listening for years.
He might ask, did you read the little words at the bottom of her every show that say like, this information is for entertainment purposes only and not meant for individual advice? Please consult your own legal, tax, or financial advisor.
Yeah, you're way nicer than I would think a judge would be. I thought the judge would look at me and go, that's entertainment. That is not advice.
Yeah. Oh, well, Judge Judy, the Judge Judy would be like, what do you mean? Get out of here. Your mom's stupid?
Basically, I think every judge should be Wapner. That's who I grew up on. Judge Judy, that's a young kid's game. I'm a Wapner guy. But you're right. It would be, that's entertainment. That's not advice. Now, let's flip the role. And let's say somebody said, we gave them bad advice, cost them thousands of dollars. And we said, well, no, that was just entertainment. We're just having a meeting with them for fun. And the judge would come back and say, to Corey's point, well, you have a signed contract. You have a fiduciary responsibility. You're a financial advisor. You should have known these things. And that's one of the reasons why in our process, we ask for all the documents. People apply to become a client. We don't want to engage people unless it's appropriate. We know we're going to bring enough value. That's just not the case when we buy a book, we listen to a radio show, or we're reading an article somewhere online. And this is the key. This is an author who wrote this article, Natasha Gabrielle. I'm sure she's a very nice person. And yet, she's saying this is the 5 best pieces of financial advice.
That's what I realized reading this article. It's like, wait, where's the specific reference to Suze? I have no idea if Suze Orman would agree that these are her 5 best pieces of advice, and for who. Yeah, there's no one set of 5 best pieces of advice. There's 5 best pieces of advice for someone young and just starting out, for someone nearing retirement, for someone just having a kid. There's always a and who that has to be a part of that.
Corey, I think what we need to do is, instead of doing what we're thinking we're going to do with this article, what we should do, let's spend the rest of our time praising her, and then our next episode we'll just have episode after episode. We should use this clickbait strategy. We'll have 5 best pieces of financial advice from Dave Ramsey, 5 best pieces of financial advice from Suze Orman, 5 best pieces of financial advice from Mark Cuban. We'll just do that. We'll just go ahead and enjoy that click farm sort of mentality and get people clicking on our videos. I think that'd be a lot easier than writing original content that you have to back up with facts and figures. We'll just use the fallacy of authority to lean on somebody famous to get people to click on our content. So that's going to be our strategy going forward. It's certainly working for the rest of the financial world. I don't know why it wouldn't work for us. Okay, back to the article.
Well, and I want to slow us down for a second and just really think about it because it's so important. Like, we're doing a podcast that's meant to teach a critical eye on reading articles. And it took me 2 or 3 article read-throughs for the preparation of this podcast to realize, wait a second, this isn't even appropriately citing or quoting Suze Orman. This is this author's material, not Suze's.
Yeah, this is this author's opinion of this being the best financial advice. Now, I'm going to take a wild guess that this author, if that's what they really think, these are the 5 best pieces of financial advice, that this person is just starting out with money, because we're going to just look briefly at these 5 things. Number 1 is transfer your credit card balance to a 0% APR card. Now, we know evidence piece number 1 is that there are people who they think are reading this who have credit cards that they're not able to pay off in a month or 2 or 3. Because if you pay 3% on the transfer, and if you pay that off over 3 months, you still paid 12%.
Right.
So because you paid a 3% APR all over a 3-month period. So you didn't save money versus perhaps just leaving it where it was and paid it off over 3 months. So not that that's a bad thing, but for us to notice that what's going to get the most traffic on Google or when we look for articles are those articles that apply to the widest swath of society. That's not what we're trying to do here. We don't give a ton of advice for households making $80,000 a year. We want them to be able to take something away from this, be able to use some of the things that the wealthier people are using with their money. But our purpose isn't to be so widely appealing that every one of our pieces of content just gets millions of views or whatever, because that's this game, the financial media game. Mm-hmm. So number 1, 0% credit card transfer. Check your credit report.
I mean, that's not a bad idea for anybody to do.
But the best advice is to check. It's like you should be able to, like, most people who are, say, in that $200,000 to $1 million income range, your credit is getting checked so consistently from, I needed to log into this. I needed to get an account with a new bank. Oh, they ran my credit. I need to get a credit card for this discount, and your credit gets checked. I'm going to help my kid buy a car. Your credit gets, like, it's something that happens so consistently. Like, if you're not on top of your credit score, absolutely, but definitely more of a beginner thing. Mm-hmm. Now, I love this. Track your spending. Good advice for everybody, no question. Mm-hmm. But if you're not already doing it, what are the odds that you read this article? Again, clickbaity title, 5 best things that Suze Orman's ever, 5 best pieces of Suze Orman advice. But track your spending is like, yeah, you should do that. But a couple of these are kind of like saying to someone, you really should eat something most days. It's like, yes. So again, Motley Fool, by the way, they make money on us trying to make money too. Mm-hmm. They're a resource. They publish recommendations on buying stocks. So they're not a Robinhood, but they mesh well with someone who's trading on Robinhood. Perhaps, why they might have some, if we looked around, they might have a bunch of articles on Robinhood as well. You bet. Well, and in this idea that's not in here. So the next is create an emergency fund, and last is diversify your investments. And then there's a free review article, list building, all that stuff at the end. The last paragraph of nearly any financial company's website, just know that's the offer at the end. That's the attempt to engage. But here's where I would bring this. There's investment advice, there's transfer your credit card balance, there's track your spending. You know what's not here, Corey, that just stands out for me so much? Setting aside X% of your income.
True.
Because, by the way, a lot of the problems of like how to invest efficiently, all that, if you're setting aside 20% of your gross income, you can't do that too long without needing to learn something about investing. That's not usually how it works. What most people end up doing, and why these articles don't talk about it, is number one, it's boring. It's boring to talk about the fundamentals of finance, kind of like it's boring to talk about the fundamentals of fitness, you know? I'll never forget, I was talking to a friend of mine that was a former Navy SEAL, and I'd seen something marketed that says 30 days to just calisthenic weight loss, no weights needed, body weight exercises used by Navy SEALs. And I showed it to him on my computer. This is years ago, before we were so mobile dependent. And he goes, yeah, I mean, that might work, but you show me that you can work out for 30 days in a row, and then I'll make an assessment of that program or help you with your workout. But until you can work out for 30 days, there is no sense in me giving you advice. Yeah. Right. And so if you start now, if you're working out every day, you will figure out ways to be more efficient with it eventually. If you're setting aside 20% of your income, you'll figure out that some investments are more expensive than others because you'll be paying attention. But when you set aside just 2 or 3 or 5% of your income, well, then the only way you get rich is by betting it all on black on Robinhood. Or the only way you get rich is doing these other things. So I'm glad at least at the end it says diversify your investments and didn't go down the path of individual stock trading.
Right.
So good on you, woman who wrote the article about what Suze Orman writes about. So that's good. But the trouble is that until you're setting aside enough money, the most fundamental thing, the first thing that should be on this list would be save 20%. And maybe the second thing should be make sure your car and homeowners insurance, umbrella policy, life insurance is just squared away. Because if one of those things falls apart, the whole picture falls apart, and it's not talked about enough. So consider this. The stuff that's going to be cool and sexy, you are going to read about that. And the stuff that's boring, consistent, dependable, and it works,
harder to find.
It's harder to find. You got to go find this podcast. You got to have somebody share this podcast with you. And so what we'd love for you guys to do, put a comment below if you're watching on YouTube. Give us a review if you're on iTunes. We still love sending out our book to anybody who does a review on iTunes. So go ahead and do that. If you don't know how to do it, you can Google that. Or you can email us, and we will Google that for you and send you a link. But with that, Corey, anything else you want to leave our audience with before we go today?
You know, I actually, it's a great example of what financial entertainers can do. Like if you use these articles that we've looked at today, the best way to use them is to use them to create questions for you to ask rather than go find answers. Because you went down this article and each of those 5 best things created a question in your mind that you were going to go research more, find some solid academic sources, see how it fits you. That'd be a great use of this article. And so that's one easy step to make sure you're getting the most out of these is, are you using it to find more questions rather than get answers?
All right. Well, with that, Corey, thank you. And to everybody listening, we appreciate you. We love you being here. Don't forget to like, subscribe, make a comment, share it with a friend, post a review. And as always, we'll be back here next week trying to bring you more information to help you design and build a good life.